In this video, we're going to look at Marriott, the hotel chain. And what I do is I calculate the value of a company using my discounted cash flow model. And I also look at the financial ratios of the business. And I'm going to do this process with you step by step as if we're doing it together. So let's get started with the model. Marriott has a market cap of $28.6 billion. And that's the value of the company according to the stock market. And they're trading at $88.20. So one share of stock cost $88. And now we need the free cash flows. And free cash flow is the cash that's remaining each year after paying your expenses. And it's important you invest in a company with positive free cash flow, because if it's not positive, they don't have much money left to give you, the investor. Now I'm pulling the net income, which is the profit or loss on the income statement. And then I'm going to pull the revenue, which is also on the income statement, and those are the sales. These are the numbers I input. They all look fairly consistent and positive, so I should get a good value for the company. Let's look at that capital structure so we know what to discount the future cash flows by. The interest expense is the interest they pay on their debt, and that's $394 million. And we'll go to the balance sheet to see how much debt they have. We'll go to the liability section, and current debt of $1 billion, that's debt due within 1 year. And then long-term debt of $10 billion, that's debt due after 1 year. So they pay 3.5% interest on their debt. Interest payments are tax deductible. Let's get their effective tax rate. We'll go back to the income statement. Income before tax of $1.6 billion and income tax of $326 million. So the tax rate is 20%. The cost of debt is 2.9%. And to get the cost of equity, we need the beta. And the beta is how much the stock moves relative to the market. So they have a beta of 1.6. So the stock moves roughly 1.5 times what the market moves. We need some more information from the balance sheet when we look at the ratios later. We're going to get their current assets. These are mainly cash, accounts receivables, and inventory. Assets that you can convert to cash within 1 year. Let's get their current liabilities. That's $6.7 billion. This is how much money the company owes within the next 12 months. Let's get their equity. That's the value of the company according to the balance sheet. That's total assets minus total liabilities, and that's $700 million. And their EBIT, that's earnings before interest and taxes. On the income statement, it's called operating income, and that's $1.9 billion. Now we can look at their entire capital structure. So the cost of debt is 2.9%, and they have 94% of debt in their capital structure. The cost of equity is 14.5%, and they have 6% equity in their capital structure. So the weighted average cost of capital is 3.6%, and that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those dollar amounts back to today, and we get a value for the entire company of $20 billion. We divide that number by 324 million shares, and we get an intrinsic stock price of $61. They're trading at $88, so they're trading at a 44% premium. It's a sell, according to the model. Let's see what Simply Wall Street values the company at. They value them at $68. So that's pretty close to what I'm saying. I'm saying 61, they're saying 68. But in both cases, we're saying the stock is a sell. It's overvalued. Let's look at their historical stock price. And it looks like the stock was trading much higher, closer to 150 a few months ago. But it's come back down. But it still appears to be overvalued. I suspect this company's stock will come down even more. I project the company has a 47% chance of default within the next 12 months. Let's look at their financial ratios. They have a PE of 22.5, that's price to stock over earnings per share. That's a bit high. They have a price to sales ratio of 1.4, that's price to stock over sales per share. That's a good ratio. Their price to book is terrible at 40.7, that's price to stock over book value per share. It's because they have so much debt on their balance sheet, it makes the price to book look so much worse. Current ratio 0.5, so they can't cover their current liabilities, and they already have a lot of debt. So I don't know what they're going to do because they're already pretty leveraged. ROE of 181%, that's net income over equity. That's a great ROE. It's mainly because they have such a low equity number because they have so much debt. It makes the ROE look great. Interest coverage ratio, that's good. They can cover their interest almost 5 times. And they're 94% debt. So thanks for watching the video. Please leave a comment.